Okay, let me start recording this class. I think surely it's going to be useful for those who are not here, right? And I want to believe that everybody can hear me because so far can't see the chat, sir. My screen is shared. Can you hear me? If you can hear me, type 1. If you can see my screen, type 2. Well, I think everything is shared. If you cannot hear me, try and join the meeting properly. Like join the meeting with audio, okay? Yeah. All right, I think a lot of people can hear and can see the screen. All right, so as I'm talking and going, if you have any questions or something, just drop them in the comment section, okay? Yeah, all your questions will be attended to. So right here, we have a bullish candle. Remember I said that every community has a language they use in communicating, right? So when we come in the Forex market or the crypto market, the market actually has a way that it communicates to us, the retail traders. So, and this communication is done via the candlesticks. So the candlesticks are actually a language that the market uses to communicate to us, the traders. And we have many different kind of charts. So, but this right here is a candlestick chart. We have the bar chart, the line chart, but those are the three that are mostly used. And these candlesticks are the Japanese candlesticks, meaning they were invented by the Japanese. So right here, I said that in a market, you're going to find bullish candles, you're going to find bearish candles. Bullish candles are buying candles. Bearish candles are selling candles. Selling candles are the red or the black candles you find on your chart. And buying candles are the green or the white candles you find on your chart. So we are saying that a candlestick has its parts. So a candlestick has the body, it has the wicks, it has the open, it has the close, it has the high, and it has the low. Now, don't worry, we are going to get into that. So if you find a candlestick, sorry. So if you find a candlestick, let's say you find this, and this does not want to draw. I think we are not going to use that. Let's focus right here. I want to believe that everyone can see the candlestick that I want to illustrate on. The bullish candlestick right here is a big bullish candlestick. I want you to follow me closely so that we get all the parts, right? So we have this bullish candlestick. So follow my mouse. This is a bullish candlestick. With a bullish candlestick, the market closes above the open price. The market closes above the open price. So this is where this market started. It started at this point. I believe you can see. So it started at this level at the price of 1.38586. So that was the open of this candlestick, the open. Now, this right here is the close of this candlestick at the price of 1.38778. 1.38778. Now, from the open to the close price is the body of the candle. So all these that you're seeing, this thick wall that you're seeing is actually the body of the candle. Now, below it, you're seeing some legs. We call them the wicks or the shadows of the candle. And this right here indicates the low of the candle. the low of the candle, and the low right here is 1.38554. What is the low? The low is the lowest price the candle was able to hit within the market session. And so if we come up right here, you find another leg. You find another leg is shorter and is the upper wick, or the upper shadow of the candle. And this right here, 1.8, look to your right, 1.38784. That is the highest price that the market was able to hit at this particular session. And so this highest price is the high of the candle, Now, this appears slightly different on a bullish candle. And let's say this is a bullish candle. Yeah, healthy bullish candle, a healthy bullish candle. So we have a healthy bullish candle right here. And I said the market opens above and closes below. Why? Is falling, it's selling. So it opens above and closes below. So this right here remains the high of the candle, the high of the candle. It is the highest price, the high. And this right here remains the low of the candle, the low of the candle. But right now, the open price, the close price is below the open price, not above the open price. So the market opened right here at 1.38353 and closed down here. So this is the close, which is 1.38236. Now, from the open to the close is the body of the candle, and this is a healthy body. This right here is the wick. This is the wick, and you know what? You know the low and the high of the candle, right? Okay. So if you have gotten that, then we move forward. If you have gotten that, then we move forward. So in the market, we actually have bearish candles, like I said, and bullish candles. And I explained that bearish candles are actually candles that they are selling. They are actually candles that are selling. They can be red, they can be white, they can be black. And bullish candles are candles that are buying candles. They can actually be green, or they can be black. White, sorry, depending on your settings. Sometimes some people set it on other colors. So in the market, you're going to have different candlestick patterns. So we are going to have candlestick patterns that tells us that the market is buying, or they tell us that the market is selling. But there is something I want you to focus on this morning. The explanation that I'm going to be giving behind any candlestick pattern is what you should actually take note of. Yeah, so don't struggle to cram the names of the candlesticks I'm going to be giving you, or the candlestick patterns I'm going to be giving you. First, I'll be able to understand how they play, what really happens behind, or what really happens in the market before these candlesticks are being formed. That way, you're actually going to get the point. So we actually have 6 bullish candlestick patterns. 6 bullish candlesticks patterns. So bullish candlestick patterns are patterns in the market that actually tells you that the market is going to buy. The market is going to buy. So in the market, there are some certain candles that when we find them together, we get it as a confirmation that actually the market is going to buy. So at any point in the market, we as retailers, we want to identify who is the person that is actually in control of the market. If we realize that the person who is in control of the market is actually the bears, then we are going to sell. If we realize that the people or the person who is actually in control of the market are the bulls, then we are actually going to buy. Now, we do not actually want to trade against the trend. We don't want to trade against the market makers. If we are doing that, then we are actually going to be on the loss side. So in the market, we have different candlesticks. We have the hammer. We have the hammer, which you're going to see a photo of it. Okay, so this is the hammer. So in the market, you're going to find a candlestick like this. You're going to find a candlestick that has a small body. You remember the candlestick I was showing you before was a candlestick that had a healthy body, right? They had healthy bodies. You're going to find a candlestick that has a small body, somehow does not even have an upper wick, but it has a long lower wick. And now there is something that this candlestick explains. So get the explanation before you begin to cram the name, all right? So we said that when it comes to a bullish candlestick, the market opens below the close price. So it opens down here and closes above. It opens down here and closes above. So this right here is the close price, while this is the open price. So the market actually opened here. And when it opened here, watch this out. When it opened here, the market moved down. It moved down right to this point, and it was able to hit this low, which is the lowest price the market was able to hit in the market. So it hit this low, but when it hit this low, you realize that it was actually
Hello, Courage. Hello, Courage. Hello, Courage. They can see your demonstration. Make it a little bit bigger. They can see your demonstration.
Okay, nothing. Okay.
You could stop sharing and you will share again.
All right. If you can see the demonstration, please type 1 in the comment section. If you can see my screen.
Okay, it's good now. It's good now. You can see your screen.
Okay, so sorry guys, I wasn't conscious of that. Okay, so I'm going to take it over. Don't worry, I'm going to be as fast as possible and we'll get through it. So remember, I said before that a bullish candle, the market closes above the open, and a bearish candle, the market closes below the open. So as I'm saying that in the market, you're going to find candlesticks of different forms. You're going to find those with healthy bodies. You're going to find those with no bodies at all, but they have longer wicks. You're going to find those with smaller bodies and longer wicks. But all these candlesticks actually have a language that they communicate. They actually have something that they tell us, the retail traders. So we are going to have the hammer. You know, it looks like a hammer, right? So it looks like this is the handle, and this is actually the hammer. And the market opened right here and closed right here. It opened right here and closed right here above the open. Now, when the market opened right here, watch this out, guys. When the market opened right here, the bears pulled down the market. They pulled down the market, and it came right here. And this right here, if somebody can help me out, you just know that this is the low of the candle. So when the market ended right here, the bulls came in with greater force and pushed back the market towards the open. Now, when they brought the market toward the open, they were powerful enough to push it up to the close, and the close price was above the open price. Now, what does it tell us? It tells us that actually the people who are presently in charge in the market are the bulls. Now watch it again. I said the market opened right here. It opened right here. The bears pulled down the market to the low of the candle. When they pulled the market to the low of the candle, the bulls stepped in again and pulled up the market, or pushed up the market toward the open. The market came to the open and was able to move above the open and close above the open. Now, what does it tell us? It tells us that the people who are powerful in the market are actually the bulls. Now, that is a hammer. And when you find this on a support zone, or maybe you find it on any zone of value, especially support zone, you know that you're going in for a buy. Now, we have an inverse hammer. Just hope everything is okay. Okay. We have an inverse hammer. An inverse hammer, you're going to see it right here. So this is an inverse hammer or an inverted hammer. Now, when you check it out, you realize that it's somehow the same hammer that we had over there, but it is actually inverted, right? It's inverted. So let us take it again. We say in a bullish, when we see a bullish candle, it opens below and closes above. It opens below and closes above. So the market opened right here. It opened right here. When the market opened, it went down. The bears pulled it down to this low. You see, it's just a small movement. When they pull it down to this low, the bull stepped in and pulled it up to this high. When they pulled it up to this high, the momentum was not that strong. So the bears actually pulled it down to this close. When they pulled it down right here, the bulls did not allow the market to go below the open. They did not allow the market to go below the open. So they were still strong enough to stay in the market. And that is why we have something like this, an inverted hammer. So when you find this hammer, when you find this particular candlestick on a support zone, remember we are dealing with bullish reversals. When you find this on a support zone, I believe we all know support and resistance, right? So you find this on a support zone, you know that the market is probably going to buy. Now we have bullish engulfing. Bullish engulfing. And with bullish engulfing, we find a pattern of two candlesticks. So we have the first, which is bearish and is a smaller body compared to the preceding bullish. And then we have the bullish, and this is what happens. The bullish engulfs the bearish. What do I mean by the bullish engulfs the bearish? Now, when you check right here, you check the high of this candle, you check the low of this candle, you check the high of this candle, you check the low of this candle. You realize that this bearish candle is inside this bullish candle. This bullish candle has been able to touch a price below and above more than that of this bearish candle. So this is a bullish engulfing, a bullish engulfing. So what happened? Let me explain. So this right here, the market opened. We say when it's bearish, the market opens above, right? And it closes below. So the market opened above right here. And when it opened, the bulls pulled it up to touch this high in the market. So they succeeded in touching this high, and the bears pulled it back to the open. When they put it back to the open, they brought it right down here to touch the low in this market. So again, the bulls pulled a bit. Now, when you check right here, you realize that the people who are powerful are actually the bears, but it's a smaller body. And then the market opens, and this time it is bullish. It opens, and the bears pulled it down a bit, exhibiting their momentum. But the bulls were more powerful. They pushed it up toward the open price and even above the open price and took it to the high of the candle. And the bears only brought it down a bit. So in this pattern, you realize that the people who are powerful in the market are actually the bulls. So you find this pattern, the bullish engulfing, around a support zone, you are looking out for a buy. So we have the piercing line, the piercing line. So this candlestick actually opens, or you find this candlestick with when a particular market session is opening. Like, let's say over the weekend, the next session of the market next week is opening, or maybe the market closes today. The market closes today, and then the next session of the market is opening. Or maybe let's say the market closes today, let's say by 10, and then another session is opening. You find this candlestick. You find this candlestick pattern. So these are two healthy candlesticks. One is bearish and the other is bullish. But watch out for this explanation. I want to believe that all that I'm explaining, the screen is past east. It's okay now. Okay. So I want to believe that all the little explanation I'm giving you behind the candlesticks patterns, you're actually getting it, because that is what I actually want you to understand as far as candlestick patterns are concerned. So the market, this is bearish, right? So the market, and this is a strong body. So the market actually opened above. It opened right here. Bulls only took it up a bit, and then bears pull it right down. You see, some sort of really strong momentum, and they brought it right down to the low of this market, or of this candle, and the bulls only took it up a bit, and finally the bears resisted, and the market closed here. Now watch this out. As the market closed here, by normal or under normal circumstances, the market is supposed to open at this price. So where it closed is supposed to open slightly at that price. But the market came and opened right down here. So the market opened right down here. By the time when the market opened, there was nothing above here. You didn't have all this, you didn't have this bullish structure. You didn't have this green candle, or this white candle. If it's on a black and white chart, you didn't have all this. But the market did not open right here. It came and opened below. It opened even below, lower than the low of this candle. So it opened down here, and when it opened, the bears pulled it down a bit. But now the bulls took the market, they pushed it up to the high, brought it a bit down. The bears pushed it down, and the market closed. Now watch this out. The closure of the market was midway the previous candle. It was midway. I want you to take this one, take this midway point, very important. It was midway the previous candle. So when you find this pattern, it actually tells you that the bulls are more powerful in the market. The bulls are more powerful. For them to take the market from here and pushed it right up here and close midway the previous bearish candle actually tells us that they are powerful in the market. So when you find this in a zone of value, which is a support zone, you're watching out for a buy. Now we have another. Okay, we have another, the morning star. So this right here is the morning star. Now, this is a pattern of three candles. 1, 2, 3. 1, 2, 3. So what happens? This candle is very healthy. We don't really find it with wicks, but now the market, it opened right here and closed right here. Who are those that are powerful? The bears, right? Now, again, they come to this candle. Now, this is a doji candle. They come to this candle and they opened right here. And when they opened right here, the market went up a bit. It went up. The bears pulled it down toward the open, and from there, the bears put it down again toward the low, and it came up a bit. Now, at this point, we realize that the bears are not that powerful, and the bulls as well are not that powerful. It's some sort of an indecision that if you ask us at this point that who is powerful, we are not going to tell you that the bears are powerful. You ask us that who is not powerful, we are not really going to tell you. So actually the market is at a state of consolidation, indecision. But now watch this out. When the market closed above here, it then opened right here. When it opened right here, the bears pushed it down a bit and then or pulled it down a bit, and the bulls took over toward the open price. From the open, they took it to the high, and they closed just a bit lower than the high of the candle. And this pattern right here tells us that the bulls are the ones in charge in the market. So we find this pattern around a zone of value, we are looking out for a buy. Now we have, I believe everyone gets that. Now we have the three white soldiers, So in here as well, we have three healthy bullish candles. But watch out for this. Now, one thing we need to notice right here is that when we see this first candle, we see the second candle, we see the third candle, the close, or let me say, yeah, the close of the second candle is higher than the close of the first candle. The close of the third candle is higher than the close of the second and the first candle. I want to believe you got that very well. Somebody is sending a message. Getting 515. All right. Now watch this out. The close of the second candle is higher than the close of the first. The close of the third is higher than the close of the second and the first. Now, this shows that just from this candle, you know that the bulls are in charge, right? Now, again, here, it still shows you that the bulls are in charge. And here, it still shows you that the bulls are in charge. Now, this right here shows you some sort of a buying pressure in the market, a buying momentum. It tells you, like, if these guys were able, let's say this is a 1 hour candle, this is a 1 hour candle, a 1 hour candle. So this tells us that within these 3 hours, it was buying. So if we find this pattern in a zone of value, let's say a support zone, we are looking out for a buy. Remember, this is the word I'm using. I'm saying we are looking out for a buy. Now we are looking out for a buy because you're going to find so many candles like this in the market, different patterns, but sometimes you'll be wondering, why aren't they playing out the way I'm expecting? So you are always going to like look out for a buy when you find these particular candlesticks. Now we have the 6 bearish candlestick patterns. I think we have gone through the bullish, and I believe everyone understands the 6 bearish is going to be really simple. Now the bearish, these are actually candlesticks or candlestick patterns that when we find them in zones of value like resistance zones, we are looking out for a sell. So when we find them at resistance zones, zones of value, resistance zones, we are looking for a sell. You remember in the market, we are trading, resistance zones, support zones, demand and supply. Yeah. So the hanging man, we have the hanging man. We are not going to read all this. So this is the hanging man. What does the hanging man tells us? The hanging man kind of looks like a hammer, right? It's a hammer. Although the color is it looks bearish. But at one point, if you are following my explanation very well, you realize that the color does not really matter because it's the same thing that is going to play out. Now, this is what happens. The market opened above. It opened right here. I believe you can see this. It opened right here. And the bulls only pushed it up a bit above the open price. The bears brought it down. They brought it down right here. Now, when they brought it down right here, the bulls again pushed the market up, pushed it up. And you see, as they pushed it up, the market closed like just beside the open, very close to the open price. And this right here tells us that actually the bears are losing force, they are losing momentum, they are losing their energy. They can't actually, the bulls are losing their energy. they can't actually buy the market long anymore. They can't buy it for too long. So when you find this right here, you're looking out for a sell. When you find this right here, you're looking out for a sell. So even if this candle at this point, was bullish, if it was bullish, it will play the same role. If it was bullish, it means that the close is above the open, right? So it means it opened here, the bears pulled it down here, the bulls pushed it up, and then pushed it a bit above the open price. Now you see they just pushed it a bit, which tells you at a resistance zone that the bulls are actually not able to push the market any further. I want to believe you got that. So this is the hanging man. We have the shooting star. I hope everyone can actually hear me all right. We have the shooting star, So this is the shooting star. At the resistance area, you find this candlestick. Don't mind the color. The color can be bearish, it can be blue, it can be any color. Yeah, but the same thing plays out. What you're looking out for is what actually happened in the market. So we know that when it comes to bearish candle, it means the market opened above right here. So it opened right here, and then the bulls, the bears actually brought it, or let me say the bulls actually took it right up here, because the bulls actually took it right up here. Now, when they took it right up here, this is in an uptrend. The market is going up. See, it's trending up. It's trending up. Now, the bulls took it right here, but the bears pull it down toward the open. When they pull it down toward the open price, they came even below the open price. I mean, they went below the open price and touched right here. And the market closed below the open price. And this right here tells us that the bulls are losing momentum while the bears are gaining momentum. What is this? The morning star. Now we have the bearish engulfing. You have heard of the bullish engulfing before, right? I think we just explained the bullish engulfing some minutes ago. So this time, the person that is engulfing the other is the bearish candle, not the bullish. So a bearish candle is engulfing a bullish candle. See, this bullish candle is directly inside this bearish candle. So this is a structure or a pattern of two candlesticks. You have two candlesticks, and the bullish candle is inside the bearish candle. So the bearish has engulfed the bullish. When we find this, we know that actually the people who are powerful in the market are the bears. I'm not going to explain it because I think you already have the explanation, right? So if you find this at a resistance zone, a zone of value, resistance zone, you're watching out for a sell. We have the evening star, So the evening star is a pattern of, of three candlesticks. The evening star is somehow looks like what we explained or like a pattern we explained earlier, but it was somehow a bullish reversal. I don't know if you can figure it out. If you can remember it, just send it in. Let me see. So we have the evening star, and this is what happens. You see, the bulls right here are powerful. Now, at this point is some sort of indecision. You see, we are indecisive of who is powerful in the market, who has more force in the market, because the market opened right here. It opened right here. The bears brought it down. The bulls took it up right here. The bears brought it down and it closed right here. And this way you see that is somehow consolidating. We don't know who is actually buying or who is selling. So it just tells us that there's indecision in the market. And then later, the bears actually takes the market from here and bring it down right here. Now, presently, we are sure that those who are powerful in the market are the bears. And if we find this pattern around a resistance zone, we are looking out for a sell. I haven't seen anything yet. Are you guys there? Now, we have the three black house. So one, we have, watch this out. This is the close. This is the close. This is the close. So the second candle closes close price is below the close price of the first candle. And here the third candle, it closes below the close price of the second and the first. And when you check this momentum, you see it's somehow progressive. It's small, it's bigger, like big, bigger, bigger. So it's somehow progressive. And this tells us that there is high pressure of selling in the market. The bears, the momentum the bears actually have is really high. So we are looking out for a sell when we find this pattern around a resistance area. Around a resistance area. Now we have the dark cloud cover, which is as well a bearish reversal. So watch this out. This is what happens. This is what happens. The market opens right here. See, opening price. It closed right here. So when it opened, the bears took it down. They took it down. The bulls stepped in, pushed it up. It went above the open. And finally, they reached the highest price of that day. The day means this is a daily candle. Now it came down right here and closed. Now we know that the bears or the bulls are powerful. Now the market stepped and opened right here. It opened right here. I know this candlestick as well will occur maybe at the end or at the beginning of a market session. So this is another session. It opened right here, and as it opened right here, the bulls took it up a bit. Now the bears put it down. You know, if you look this way, you see it's already midway the previous candle, So they took it down, and when they took it down, they hit this price, which is the low. The bulls only brought it up a bit, but they could not go above the mid of this previous candle. Now it closed right here. And when we find this, and if we see this, like this right here is a confirmation, all right? So this right here is trying to give us a confirmation. So when we find this pattern, we are looking out for a sell. We know that actually those who are powerful in the market are the bears. I want to believe that you got that. All right. Now, in the market as well, we also have continuation patterns. We have patterns that tells us that the market is going to continue. We have candlesticks that tells us that the market is going to continue. Now, we are going to get an explanation to why the market is actually going to continue, okay? So we have the doji. We have the doji candlestick. Now, how does it look like? The doji. So we have something like this. Now, watch this out. Now, let's say the market is actually like these are continuation candlesticks. Now, let's say the market is actually rising. It's actually in an uptrend. Now, you see this right here tells you that there is indecision in the market. There is indecision in the market. Remember, if we want to explain this, that it opened here, came down, and then the bulls pushed it up, it reached here, the bears brought it down, it finally closed beside the open. You know, it's indecision. And then this same thing, it happens, it's indecision. So when you find doji candles, when you find doji candlesticks patterns or doji candles around an area of value, what should first come in your mind is that there is indecision in the market. Listen very well. What should first come in your mind is that there is indecision in the market. Now, meaning when the market is indecisive, you, the trader, you want to watch what actually happens. You want to watch what plays out. So imagine that at a resistance area, meaning at a ceiling, you know, resistance is above. At the resistance area, you find out that you're having candlesticks like this, the dojis. You're having candlestick patterns like this. Now it's telling you that there's indecision in the market. Now it means that the market can actually move to the upside. It can keep going up, and it can well go down. It can as well go down, but there's high probability that it is going to go up. It is going to buy them more. Why? Because actually, whenever when you're analyzing your chart, you realize that whenever there is a zone, when the market reaches that zone, it must react to that zone. It must react to that zone. So you take this for the reaction at that zone, and you're watching out to see if the next candle that will be forming, if it's actually going to be advancing bullish, or is going to be advancing bearish. But you're looking out for bullish. Now, it's the same thing if this is happening at a support zone. If it's happening as a support zone, you know that at this support zone, the market is indecisive. It's indecisive, and you're looking out for who is going to come forth and push the market up or pull the market down. Now we have the spinning top. The spinning top. I want to believe everybody, you can hear me clearly, and you can see my screen, right? So we have the spinning top. You're not going to read all this. So this is what happens. The spinning top. The spinning top. The spinning top again is another set of doji candlesticks. We bullish, bearish, yeah, bullish, bearish. But now watch this out. It has long wicks. Now, if we want to take the explanation of the spinning top, it's actually going to tell us that the market is indecisive. If you look right here, you see there's an arrow pointing down and another pointing up, pointing down, pointing up. Now, when you find this in the market, it's telling you there is indecision. So you want to watch out whether the market is going to rise or is going to fall. So if you find this at a resistant area, you find this at a resistant area, you know that the market is actually reacting to that resistance, and you're watching out to see whether the market is going to rise or is going to fall. All right. Now we have the falling tree method. The falling tree method. The falling tree method is a set of three candles, bullish candles. Okay, they are bullish candles. So let's say you find a downtrend. The market is actually trending down. See, from here it's coming down, and then you find this three, 1, 2, 3. These three are different from the progressive three candlestick patterns that we saw before. Remember, it's actually different. Now, when you check the momentum of this candle, this one, you see, it's not progressive. It's not progressive. This one, you see, somehow like the momentum is reducing. It's reducing. So, like, some people usually get confused with this and the progressive candlestick patterns that we saw before. So when you find this right here, you find in a downtrend, you find bearish candlesticks, and then you find three bullish candlesticks playing out like this. And when you watch this out very well, what I want you to identify is that the momentum from when you see this candle, you see this, you see it's good, but right here you see the momentum is reducing in the market. The bullish momentum is reducing. So when you find this in a downtrend, you're looking out for a sell. Know that the market is actually going to continue in its present direction. Now we have the rising tree method. The rising tree method, and this is what happens. We actually have the market rising. It's in an uptrend. It's in an uptrend, and then we begin to have these bearish candlesticks. We have the first bearish, the second bearish, and in our mind we are thinking that this is going to be the three falling candlesticks, which is progressive, and we will be looking out for a sell. But actually we find out that the momentum is reducing. See, the momentum is reducing. We check this, you check this, you check this, you see, they are not progressive. The momentum is reducing. And so right here, we are looking out for a continuation. If this is at a zone of value, a resistance zone, we are looking out for a continuation. I want to believe we all got that. I want to believe we all got that. Now, at this time, I really wish this is some minutes past 5, close to 6. I wish we could go to market structures. Yeah, market structures like formations, market patterns, different patterns in the market, but it's about 6 o'clock. So I want to believe that you actually grab something in this class. So you have an assignment. I'm looking up here, I'm not finding questions. Not seeing questions. You have an assignment, and this is the assignment. You're going to go to your chart and then you look out for all these patterns. You'll be able to identify all these patterns. Look out for them. Like go on your chart, look whether maybe you're seeing something. Like, you know, right here, you're seeing a particular pattern right here. Can somebody tell me the name of this pattern? You are seeing a particular pattern right here. And so when you're going to go to your chart and then you'll be able to identify these patterns. Now, there is another pattern. There's another pattern which is not in that book, that in that page we saw, and I want you to take it. They call it the harami. The harami. Harami means pregnant in Japanese. The harami. So the harami is actually somehow, it looks like an engulfing pattern. It looks like an engulfing. I want to look if I can find harami here. So I'm seeing a bullish harami. So check right here. This is a pattern. This is a pattern. You see, it's bearish, it's bullish. Now, this is not bullish engulfing. This is not bullish engulfing. Now, instead,
But please, we are not seeing.
Your screen is
Your
showing
screen
it.
is not showing.
oh, sorry. I'm not okay. I think I'm right here. Share. Okay, is everyone seeing? Oh, sorry. I'm actually learning to use Zoom. Okay, so it's now that I'm getting the point when it comes to this sharing. It's like, you know, if I want to share something, I need to come and choose it right here before it shares. So I get the point now. Okay, let me explain again. I'm saying that there is actually another candlestick pattern which they call the harami. So we have the bearish harami or bullish harami. So the harami as well, in some books, you are going to hear it as Switzer. Switzer. So if you hear something Switzer, you just know that Switzer is actually harami. So you can actually have a bearish harami and you can have a bullish harami. And I said that a bearish harami is like it's actually like an engulfing, but it is the reverse of an engulfing. So you know that engulfing means that if this was actually bullish engulfing, it means this bullish is supposed to be like, you know, the momentum is supposed to be more than that of the previous. But here we have a bearish candle, we have a bearish candle, and then we have a bullish candle. And I said harami in Japanese means pregnant. So this bearish candle is pregnant of this bullish candle. So when you find this candlestick, when you find this candlestick, this is bullish harami, bullish harami. When you find this candlestick in a zone of value, which is a support zone, you're looking out for a buy. You're looking out for a buy. And then if you find this same candlestick, if you find this same candlestick in a resistance zone, you're looking out for a sell. Let me say it again. I'm saying that if you find this candlestick in a support area, you're looking out for a buy. You find it in a resistance area, you're looking out for a sell. Now, you want to watch this out very well, because there are places where the harami plays out to be a bullish reversal, it plays out to be a bearish reversal, and it also plays out to be a continuation. Now, how do you trade this candle? How do you trade this candle? Let's say you want to trade this candle. This is where it opened. This is the low, and this is the high, right? So if you want to trade this candle, you wait for the market, or you wait for other candles to break above, like to break above here, a healthy candle, not weak rejection or something. You want to look out for a candle that will actually break above this price and then begin to progress. When it breaks above and closes above this level, you know that this pattern right here played out to be a bullish reversal. If it breaks and then comes right here, forms closes below the low in an uptrend, you're looking out for a sell. You know that this signal that it was going to be a sell. So if you want to look very well, you see, okay, something like that played out here, something like that played out here. And this is what tells us, respective to this, that it's actually going to rise. See, there were rejections right here. It actually tells us it's going to rise. Good. So we as well have the bearish harami. I don't know if I can find a bearish harami. I think right here I can see this is a bearish harami. So check this out. This is a bearish harami. So this is bearish candlestick, and this is bullish. Now the bearish is the bullish, like, is pregnant of the bearish. It's harami. So you see that this right here is actually in this bullish candlestick, and it is different from the bullish engulfing or bearish engulfing. It's actually the reverse of it. So when you find this, it actually tells you that the market can actually reverse, or it can continue. So if you find this candlestick at a resistance area, you are actually looking out for a sell. But if it plays out to be a continuation, it's going to be a buy. But remember, I've given you how you trade this particular candlestick. What happens is that you take the high and the low. You have this right here, you have the high and the low, and you begin to watch what is going to happen. If you find out that the market, like this bearish, it closed below the low of this low. The moment you find this, you know that the market is going to sell. This pattern here played out to be a reversal if this was actually an uptrend. But if it goes above, you know that actually is playing out to be a continuation if it is in an uptrend. So I believe we got that. Okay, guys, thank you. Let me read some questions. Okay, does it mean the difficult candlestick can be used to determine does it mean the different candlesticks can be used to determine the market trend only when they occur at resistance points? Okay, that's a good question. That is a good question. Take this explanation. When you find like these patterns, right? All these patterns we have seen, you're always going to see these patterns in the market. But the fact that you're seeing them in the market does not mean they are valid. Now, the information a candle, like one of these candlestick patterns, is giving you at a zone of value is different from the information it is giving you at a zone that is not a zone of value. So if you find any of these candlesticks at resistance zones or support zones, the information it gives you is somehow solid. Now I will explain. If let's say you find a candlestick like a bullish engulfing, you find a bullish engulfing in an area where you know that this area is not a zone of value. Let's say let me draw this. Just watch this out. Okay, I want you to watch this. Just watch this, what I'm going to explain here. So let's say the market, this is the market playing out. And you know very well that this is a zone. Like this is a zone right here. This is a zone right here. And as well, the market was playing out. It was playing out and coming. It was coming. Now, at this point, I want to believe everybody can see. At this point, you found a bullish engulfing. At this point, you found a bullish engulfing. But when you look your left, this is your left. Your left as a trader is very important. When you look your left, you realize that there is no zone of value. There is no zone of value playing out here. So you are, as a trader, you're not just expecting the market to just reverse right here. So if the market is reversing right here, it doesn't concern you. You're waiting for it at another zone. You want to, as a trader, you want to sell the market. You want to buy and sell at the lowest point in the market or the highest point in the market. So if you find a bullish engulfing right here and you were expecting it at this zone, you find it right here, the information it gives you is different. Is different from the information it will give you at this point. So let's say a bullish engulfing is telling you that the bulls are powerful. So the fact that the bulls are powerful right here does not mean that the person who is actually going to move the market further is going to be the bulls. So the bulls at one point in the market can be powerful, the bears can be powerful. But when the bears are powerful, or when the bulls are powerful around a zone of value, it gives you more information as to what is going to happen in the nearest future. And you know, as a forex trader or crypto trader, you want to be able to bring in probability and predict what is going to happen in the nearest future. So if you find out that there is a bullish engulfing at this point, it's a bullish engulfing at this zone of value, then you're looking out that the market is going to buy. Is going to buy. And if the market buys, it would have brought us to a certain pattern that we'll call it the W shape. Prof is going to work on it. If we have another chance, we are going to take it. So this is what plays out. This is what plays out. So you see what happens here. But if at this point you realize that it's giving you continuation patterns, then it's going to break. It will break and come down here, maybe retest and then continue to sell. So I believe that your question was answered, right? If there's any other question, let me see. Does it mean? Okay. Close price. Now, I think this is going for the particular pattern we explained. Now, what we want to identify, like I said, in the market is who is actually powerful in the market, who has more force, who has more momentum. Now, if you realize that a market session closed bearish, and let's say it closed bearish and it was at this price, it was at 139057. It was at this price and it closed bearish. Now, when it closed bearish, the market again came and opened. It opened below the close of that day, of the previous session. It opened below, and then we are expecting the market to go back down. It opened below, it should go down. But this is what happens. As it starts going down, the bulls steps in and push the market. And they push the market, and it even goes 50% above, like goes above the 50% or midway the previous bearish candle. It's telling us, the information is just telling us, it's telling us that the bulls are powerful. The bulls are powerful in the market. If they are not powerful, they are not going to push the market above the midway of the previous candlestick. They are not going to be able. So the fact that they are able, it means that actually they are powerful in the market. Please, for the spelling of Harami. It's not Harami, it's Ha, H. There is an H ahead here. Harami, Harami. You're going to find it. You're going to find it. I believe you're going to make some research on it. Okay, somebody is talking of resistance and support zones. Our class is almost over. This is 6. Some people need to go to work. Okay, but I want to believe you will get this. So support zones, but support zones is actually not what we are working on today, right? But this is what happens. Okay, like this is, you see the market right here. If you're looking very well, you realize that the market right here touched here. It touched here, came down here. You see, it's kind of like creating lower highs and lower lows, creating lower highs and lower lows. Now, there are some points in the market like this price. Check this out. From here, at this price, 1.400, check at your right here, 1.400. What happens is that the market actually formed something. It formed a certain ceiling right here. And see, in the future, when the market came towards this zone, it reversed. Now, it actually tells you that this is a resistance zone. It's resisting the market from going above. And right here, you find out that something happened here. See, something happened here. Look right here where my mouse is. It happened here. If I want to take it, you see how it's affecting the market around this area. But check out what happens presently. See, look right here and see something happening. See something? The market is rejected at this point. So this somehow is a support zone to this market. Although it was broken, when it is broken, it becomes a resistance. When it was broken, see, the market got resisted. So what is a support zone? What is a resistance zone or a support area? A support is actually a zone that is keeping the market above. It is keeping the market above a certain price, like this right here. This right here. This is a support. This is a support. As traders, we are expecting that in the nearest future, if the market is coming down, when it comes and reach here, it should maybe be rejected here and move back up. So this happens to be a support. And a resistance is any zone in the market that is keeping the market below that particular price. So like, you know, this zone is keeping this market below, it's keeping it below. So it's actually a resistance. I believe you get that. But now those are our patterns. When you check, when you see those patterns around here, you are looking like you see bullish reversals around here, is going to buy, right? You see bearish reversals around here, is going to sell. You see, let's say at this point, midway, you find continuation patterns here, you know that this thing is going to continue. If you find reversal patterns, let's say bearish reversal, you know, is going to go down. Okay, what is it? Okay, thank you guys, thank you very much. I want to believe that you actually got something. I would have loved to continue, but there is no time, right? We all need to go to work. So Prof is going to, there's another part of this class that was going to be handled, which is actually chart patterns, no more candlestick patterns, chart patterns. So chart patterns, you begin to find out that the market moves in a certain pattern at a certain time. So one thing I want you to get, whenever that class will be done, take it to very important, because chart pattern is one of the strategies in the market that every other trading strategy respects. So when a chart pattern is playing out, when market patterns or chart patterns are playing out, no matter the strategy you're using, the market, if you don't want to trade that pattern, you don't know how to trade that pattern, no matter the strategy you're using, you're going to actually fail at it. Okay, guys, thank you. The class has ended. Have a nice day. Have a wonderful day. Do well to read, do well to make your research, do well to study. Okay, thank you. God bless you all. So we can now leave the class and go to work. Have a nice weekend too. Okay. Prof, are you there? Prof is out. Prof.